Hey everybody, it's Larry Berman here. Well, we've been through the Jackson Hole Powell press conference speech. Um, really didn't say much. There was some speculation that he would be, the dove that he is, and when the markets closed on Friday, that seemed to be the interpretation. Remember, we went out very strong post the July 31st FOMC and woke up to a change in Japanese bank policy and 3 days of carnage in the stock market as unwinding of a carry trade played out. So got a couple charts to look at this week, see what's on our radar here, and see if we can make heads or tails of this very, very high risk environment with a lot of uncertainty. Yet when you just look at the charts, you say, why shouldn't I be in the market? Pre-Powell press conference, the odds of a 25 basis point rate cut was fully baked in, with the odds of more than 25 sitting around within a bid-ask spread of where we are now. So the market actually still slightly favors the Fed cutting rates, perhaps starting with more than 25 basis points. To us, that would mean a pretty material decay in the labor market between here and September 18th. If that is the case, equity markets should not be bid here. And so markets looking at more aggressive rate cuts at this point, as if we sit right here at Friday's close, as a positive. And again, I don't see it that way. I see the Fed being more aggressive, or the need for the Fed to be more aggressive other than slow and measured, with the occasional pause between meetings, not wanting to trigger inflation again. Economy is stronger than the kind of perception, I think. And with that framework, the Fed does not need to be aggressive. So as you can see here, more than 100 basis points priced in between now and the December meeting, with pushing on, a year from now, better part of, fully eight 200 basis points, 825 basis point moves, fully baked into the cake. Again, to me, if they have to go that much, it's a harder landing. So equities then get mispriced. If they have to go that much to slow the economy because the economy's hot, then that's a different story here, because they're not cutting to slow the economy, right? If the economy's too hot, driving earnings, like, this is what doesn't make a lot of sense here. So let's look at the next thing, because on July 31st, markets closed strong. We had already started to see some strength in the Japanese yen. And here's July 30th, 31st, change in Japanese banking policy. We heard from Ueda on Thursday, and basically confirmed that a tighter policy in Japan is likely. Saw some strength in the yen, maybe more about dollar weakness given the Fed's confirmation that they're going to start cutting rates. Maybe a little bit of both, but the stronger this gets, the more pain there is on the leveraged borrowing in Japan. So this is going to be pretty interesting as we get into the dog days of summer, and in theory, liquidity is a little bit less. We saw equity markets whip dramatically this week, where we saw a massive reversal pattern on Thursday, we got the Jerome Powell, I think most were expecting, and we ended up regaining most of what we lost on Thursday and closed the week at the high close of the week, not the high point of the week. If you look at small caps, you know, you haven't taken out the highs from late July. Again, here post FOMC, but you got a pretty strong close in small caps. Again, small caps should perform better in a rate cut cycle. But again, to us, we haven't had the hard landing that we should get at the end of every business cycle. It would be completely bizarre that we don't get one this time around. But again, that's where the markets are looking. If we look at the Qs, again, we are now above the end of July highs on the Qs. We had the reversal pattern, which looked like a failure on Thursday. But in the case of the Qs, we didn't take out the highs from earlier this week and on a closing basis. If we look at the S&P 500 in the same way, we did get the high close of the week. And if we look at the equal weight S&P 500, you closed at the high of the week and you took out the July highs. So the average stock is liking the rate cut cycle that's coming and it's now been confirmed. And so that is a positive for market breadth. But the overall index is still, I'm struggling with here because I think that the hard landing ultimately is coming. So it will depend, as the Fed says, on economic data, and we'll see what is in the pipeline as it comes out in the coming weeks. In terms of energy markets, you know, we saw a pretty big pullback. Usually weakness in any energy markets is a forecast of a slowing global economy. We did reverse and bounce. We'll see if there's any follow through in the coming weeks. But really, for this to be bullish, other than range bound, as we've been in recent months, we need to start making higher highs and take out some trend lines. So if we were to draw this trend line across the highs here of the last year, you know, we've got to call it breakout above 85 to really have confirmation. Stronger economy, Fed can't cut into that, inflation worries. So that's something in front of us. We need to pay attention to that chart as well. From an economic perspective, the S&P PMI numbers came out this week with a downtick. That could have been some of the inspiration for the weakness on Thursday. It was a Thursday number that came out. Again, markets reversed that on Friday, but we're now back below with PMIs. We know for the better part of a year and a half now, U.S. manufacturing has been in a recession. So that's not a surprise to anybody. But it is really remarkable that the consumer keeps firing on all cylinders, largely because the consumer's fully employed. We did get the update this week of the annual revisions. And the understanding now is that instead of from March 23 to March 24, instead of creating the 2.9 million jobs that we saw in the non-farm payrolls, there was 818,000 fewer jobs when they actually counted the tax receipts that came in. So the birth-death model in the monthly employment data is pretty far off the mark. And so, again, when Powell talked about the notable weakness in the labor market or easing in the labor market as a positive, this is why they need to start cutting rates now. So they don't want to fall behind and cause a recession. So they're trying to catch up in that sense to the curve, but we think the curve is now pricing in a pretty aggressive easing cycle, which we don't expect we will see unless we get a hard landing. And so looking at the initial claims, clearly the trend of the 4-week average in claims softer in the last couple weeks, but generally we're starting to see that rise. That trend still benign. That number needs to get up into the 300K per week for the US economy to really start net losing jobs. So it'll be interesting as we get into early September as to what the August employment data says. But during survey week, we saw a downtick in claims. And so I would expect a decent employment number. And for now, maybe the markets are okay unless we start to see these reversals continue to play out and support break. So at the end of the day, looking at the S&P 500 equal weight, you'd say there's no reason for me to run from the markets. Now, I do think there's every reason to be cautious and to not put new money to work because, again, the economic backdrop to me is very, very fragile. And, you know, there's a lot of leverage in the system still. That leverage has not been worked out. In fact, may have even come back in the last couple of weeks. So bad news is probably going to upset the equity market in terms of the economic growth numbers, in terms of the labor numbers, and that's really going to be the focus, you know, right into the US election. Anyways, that's all we have this week. Have a great week, everyone.